Good evening and welcome to the Money Show. I'm Kavita Thapliyal and this is the place where money stops being confusing and starts working for you, because let's face it, every decision we make, from the coffee we buy in the morning to the home we dream of owning, from planning our next holiday to securing our children's future, has one thing in common, that's money. Yet despite the role it plays in every chapter of our lives, very few of us were ever taught how to manage it, grow it and make smarter financial decisions. That's where we come in, whether you are just starting your financial journey, building wealth, investing for the future, planning your retirement, or simply trying to make your salary stretch a little further. This is your show. In this show, we also open on the counter to answer your portfolio queries. Just in case anything you have, right from investments, insurance, taxes, credit cards, or anything specific you want to ask our experts, send across your question on the WhatsApp number that's flashing on the screen. It's 865-797-4571. And the email ID is themoneyshow@etnow.tv, the place where we help you align your financial decisions and strategies to your financial goals. And today we put the spotlight on insurance. And in insurance, life insurance is designed to provide financial security and long-term protection for individuals and their families. However, recent data from the RBI and the irdai shows that a growing number of policyholders are surrendering their life insurance policies before they mature. We'll flash some data on the screen as well. Now, this trend raises concerns about customer satisfaction, financial planning, and the way insurance products are sold. According to the RBI, 38.3% of total life insurance payouts in FY26 are due to policy surrenders and withdrawals, while 36.9% were maturity payouts. Now, this means that more people are exiting their policies early than waiting for them to reach maturity. The RBI believes that persistently high surrender rates may indicate policyholder dissatisfaction, mis-selling, or competition from other investment products. The 61st month persistency ratio, which measures the percentage of policies that remain active after 5 years, shows that only about half of life insurance policies continue beyond this period. Now, among insurers, ICICI Prudential Life recorded one of the highest persistency rates of 58.8% in FY25, while Shriram Life had one of the lowest at 25.9%. Now, this suggests that many policyholders discontinue their plans before completing their intended term. Experts identify several reasons why people surrender their policies. The policy does not match the customer's financial needs. Financial emergencies or cash shortages require immediate funds. Personal financial priorities change over time. Policies are often sold as investment products rather than protection plans. Now, actual returns fail to meet customer expectations. So, early surrender of a life insurance policy can result in financial losses, reduced insurance cover, and lower returns. Therefore, individuals should carefully assess their financial goals, understand the terms of the policy, and choose insurance primarily for protection rather than as an investment. The increasing trend of surrendering life insurance policies highlights the need for better financial awareness and responsible selling practices. Customers should make informed decisions, while insurers should focus on transparent communication and suitable product recommendation. A well-chosen life insurance policy can provide long-term financial security when maintained until maturity. But let's talk more on this and also answer our viewer-specific insurance queries today. I'm joined by Mahavir Chopra, founder of Beshak Health Insurance. Mahavir, hi, good evening and welcome to the show. So very interesting report that's come out, but because you're an expert and been in the industry since quite long, comparing the surrender payout percentage, 38.3 with the maturity payout percentage of 36.9, what does this reveal about consumer behavior according to you?
Right. So there are two aspects of this, right? The first aspect, of course, is that the way these policies are being sold, the entire terms and conditions of the policy, specifically related to the money being locked in for a particular period of time, that the fact that you cannot withdraw it till a specific number of years, and that the maturity will happen after a particular period, which are two different things. How many years you need to make the premium payment is something that is not understood well when the policy is bought. Now, there are both problems in this. There are times when, of course, the customer is not informed about this, and there are also times that we see where the customer does not take efforts to understand this well also. So of course, meaning any financial product, the final burden of explaining the product well has to be with the seller. And that's why I would always say that, the practices and the incentives that are being offered when a product like investment is being sold specifically to vulnerable class, the lesser educated class, specifically senior citizens, has to be tightened a lot, so that these kind of situations where there is a surrender required and there is a loss of money, there are basically financial goals that are not met, is completely avoided.
All right, so that's the take coming in. And yes, but then we have to figure out a lot of other factors. What, according to you, would be the reason why consumers are surrendering the policy before the maturity period? I mean, is it mis-selling or disappointment with the returns that they are getting?
Yeah, mis-selling is a large portion for sure, and that has
Right.
actually been now picked up by everybody, right from Ministry of Finance, DFS, even RBI and IDA now. And it has been basically something that has been spelled out very clearly. Incentives are being aligned right now as we speak. IDA is trying to solve for it. So for sure, mis-selling is one of the major reasons why these early exits happen. But the other part of it is also this, that as customers, we also need to become more aware of such products and not just basically buy into the sweet talk that happens over a coffee or a tea in a bank or in your own house, right? Ask important questions which are going to help you understand what are you committing into, what are you going to get out of it, right? The three important questions that I typically ask people to ask is, one is that how many years am I committing to pay, which is something that most senior citizens are not told, or they don't are completely left unaware. They understand it like an FD, whereas actually it is a premium payment that happens over 10 years, right? The second is how many years is the money going to be locked in before you can even withdraw it with the kind of maturity that has been offered by the insurance company. A lot of people feel that this is like an FD जो मैं तोड़ सकता हूँ, I can just break it whenever I want. I'll have some small penalty and I can withdraw the money. But when it actually happens, there's a very, very significant deduction that happens, and then customers feel cheated. And the last is a lot of wrong commitments are made, or a wrong amount of misconceptions are there around returns. A lot of people feel that if they're paying 1 lakh today for the next 10 years, and from the 11th to 21st year, if they're getting, let's say, 2 lakhs per year, they feel they're getting double returns. But it's not true. When you actually put it in an Excel sheet, or you even ask AI to do the calculation today, if it's very simple today, you will come to know that the actual returns come to the amount of around 4.5 to 5% IRR per year, right? So on one side, there is an absolute return that basically makes you feel and gives you a misconception that you're getting double the money. On the other side, when you do a calculation, you come to know that it's just 5% year on year return. So these are the things that customers need to understand: the commitment that they're making, the amount of lock-in that the money is going to have, and the returns actually calculated if you can't do it yourself, with the help of a financial advisor whom you can trust.
One very important thing, why is the 61st month persistency ratio an important indicator of an insurer's performance?
So typically, Kavita, the thing is that most of these policies have a 10-year term, right? And if someone is dropping off mid-term, right, the amount of money that the customer is losing is significant. It also is an indicator which helps, the industry also understand what has been the quality of the business and what is the quality of the customer that they have basically onboarded, right? If a customer has paid for so many years and he drops off, that's a significant indicator or a signal that the customer was probably not explained properly, or he misbought the policy, right? First year indicator, in fact, is even higher in my view. People who are dropping off in the first year clearly is a signal of mis-selling to a large extent. Fifth year onwards, it also becomes a mix of mis-selling plus customer behavior, where customer is not able to sustain. They have problems like you mentioned, where they basically are facing financial struggles and they're not able to sustain through paying over the next 5 years or next 20 years.
All right, now, let's compare the persistency ratios of ICICI Pru Life and Shriram Life. What factors might explain the difference according to you?
Any company where you're seeing a persistency difference, right? It is clearly an indicator of the quality of the business, right? So if a company has better persistency, it clearly shows a that the customer profiles have been chosen properly, the suitability has been understood correctly, that the customer actually has that kind of profile and background that they will be able to pay over a period of time, versus someone who has basically either been missold or an unsuitable policy has been sold to the customer. So it's a indicator of two things: the quality of sales and also the quality of the customer base of that insurance company.
All right, one last question, and then we'll take a break and dip into our viewer queries. What if a customer wants to surrender a policy after 3 years because maybe mutual funds are giving them better returns or any other investments? What factors should they consider before making this decision?
Right. So first of all, it's supposed to be something that you have to understand when you bought the policy, whether it was actually something that matched your needs, right? Typically, if you have bought a life insurance policy, which is an investment policy, without understanding the three things that we just spoke about, then it is better to exit the policy, because you've made a decision, and that decision was not made on facts, not made on understanding your needs, right? There will of course be a loss that you will have to bear, but I always, whenever I talk to people who have to go through such decisions, I tell them that this is a learning cost or a tuition fee that you're paying to learn the mistakes that you've made. You're basically going to learn this for your life, and you won't do it again, right? So that's the kind of things that you'll have to look. Typically, the loss that you have to bear is something that you have to bite into, and then you take a decision and move into actually talking to a professional financial advisor and taking a decision. The other question that you asked was basically, I actually missed your second question. You also asked me one more question.
So I wanted to ask you that, what should be the plan ahead for them? A better surrender
Yeah.
strategy would be what?
Right. So there are two options that are available, Kavita. One is the option of surrendering, where you will have to obviously bear a loss. Typically, that's what we recommend to customers, that you just get out of it. It's always better to do that. But there is also another option that is available, where you could convert your policy into a paid up policy. What happens is that proportionately all your benefits, let's say if you had a 10-year term and you want to drop off in the fifth year, then all your benefits, including the life insurance cover, the maturity benefit, will be reduced by 50%, because you're paying only for 5 years. And that will be something that you will get after the policy term ends. So people who have basically a psychological or a mental block that they do not want to lose money, they could probably also use this slightly suboptimal option of converting their policy to paid up if they feel that they made a wrong decision.
All right, perfect. This was about making the most of your insurance policies. But let's dip into a short break, and post that, let's get connected with our viewers who've sent a lot of insurance questions. Just in case you want to be a part of this particular show, send across your questions on the WhatsApp number that will flash on the screen, and the email ID. Anything about investments, insurance, tax, credit card, or anything about any of your financial goals, we'll help you invest, and we'll help you with the right strategy for you by our experts. Welcome back. You're watching The Money Show, and we are focusing on insurance queries now. Mahavir Chopra, guest on the show, will be answering all our viewer queries. Mahavir, welcome back. Let's take Jahangir's question. He's from Moradabad and 28 years old, and he's unmarried, wants to know if life insurance is necessary at this current stage in his life, and should he buy a policy today or wait until he has more financial dependence. All right, so let's begin with the thumb rule of buying the right kind of life insurance, and what would that be?
Sure. So typically, any insurance or any financial product that you're buying, you should always, Jahangir, first look at whether you need it. Understand the need of the product. Just don't buy it because someone else tells you to buy it, or don't buy it because you want to buy it. Understand the need of the product, right? What is and when is the need of a term insurance arise? It arises when you have dependents, or you have visibility of dependents in the future. So in case you are right now 28 years old, and in case you clearly have financial dependence today, or you are seeing a visibility of financial dependence in the future, then you should definitely buy a term insurance. In simple words, what is financial dependence that you have, or when do you have them? When you are paying substantial expenses for your family, or you're contributing to your family's lifestyle in terms of footing certain bills, paying certain charges. for your house. Like, for example, you're paying EMI, you're paying rent, you're paying sizable costs that ensures that your family lives a good life. That specifically is something that explains whether you have financial dependence or not. In case you do not have financial dependence, or you do not have a visibility of financial dependence, it's always good to wait and buy it later.
Uh, but then what about having it now at a cheaper cost? Because right now, if he buys one, he might not have any financial dependence, but he will get he will lock in the right price.
Yes, Kavita, that's absolutely right. But if I'm a individual who clearly feels that I am not going to have, let's say there's someone who's never going to get married, for example, and he lives with his parents who both are, let's say, for example, doctors who are doing very well, then in that case, his absence is not going to impact anybody, right? When his absence is not going to impact anybody, then there is no need of a term insurance, because there's no person or any family member who needs financial security. So even if it looks very lucrative, it comes at a cheaper cost. The fundamental will always be whether you have a visibility of a financial dependent in the future. If you don't have, then you could probably use the money for probably saving into some other investments or something else.
Perfect. Let's move on. Let's take Rehan's question. He's from Aligarh. And so he says that he forgot to disclose a minor health issue while buying life insurance and wants to know if this can lead to claim rejection and what can be done now because he's bought the policy.
Right. So a minor miss from your side may not be a minor miss from the insurance company's perspective, right? An insurance company basically evaluates your case basis a lot of things, and something that you feel is minor may not be minor for an insurance company. The thumb rule and the broad fundamental here is always declare everything and anything that you are aware of, including diagnoses that have happened, treatments, medication, or even symptoms about anything related to your health should be informed to an insurance company always. Now, in this current scenario that you feel that you've missed something, it's always good to go ahead and come out clear with an insurance company and let the insurance company know. It's always better that an insurance company right now cancels your policy and you get that jolt today and you find out a better policy for today for your family in the future, rather than having an impact at the time of claims when you really need the money or your family needs the money, and that time there is a claim rejection. So honesty in case of insurance is definitely the best policy. Never go the other way around. Always disclose everything. If you miss something, go ahead and inform it.
Perfect. Let's take Sheetal's question. She's from Mumbai. She wants to know whether a nominee automatically receives life insurance proceeds, and can legal issues arise over who ultimately gets the insurance money?
Right. So as per the not very recent, but recent updates that happened with the Insurance Act, there's something that came in which is called the beneficiary nominee. So if you're basically nominating anybody when you buy a life insurance policy who is basically a bloodline member in your family, then that person basically gets the money and can use the money. That is how it usually works. But we've seen a lot of court cases that have happened after this specific scenario, after this specific law being enforced, where we've seen that the courts have overruled this specific rule where beneficiary nominees are supposed to get the money, over saying that this succession act for that specific community will be applicable, right? In such scenarios, like you said, that should there be any legal issues, the best way to solve this is to basically create a will. Now, a lot of people feel that will is supposed to be created by someone who's probably retired or someone who's 70 years old, but that's not how it should be working. You should, as soon as you are creating a term life insurance policy and you have sizable amount of wealth, it's best to create a will so that there is no complication when actually the money is come on the table for the family to distribute between them.
Right. Also, after you have your nominees placed in your insurance policies or maybe even the will, can we change it? How many times can we change the nominee selection in a given investment instrument?
You can change it as many number of times, meaning,
Okay.
and a lot of these insurance companies and even banks today offer change of nominee over their internet websites, right? On their websites. So you don't even have to go to a branch to do change of nominee. You can simply basically update the nominee on your website. You can even change the proportion. Like for example, someone has made their mother a nominee, and then they get married, and now they want to ensure that their wife or their partner also gets financial protection and security. They can go and change it to, let's say, 50-50 for an example, right? So those kind of things can be done. Even if it cannot be done on a website, you can walk into any branch of the insurance company and get it done. In case of will also, of course, you can change your will as many number of times. You obviously need to ensure that it is registered and you have the basics, the checkbox that you need to do, which is ensuring that it is there are people who know about it. It is probated. That is something that you should do. The registered, basically, not probated. It is registered. What you should do.
Question is coming in from Manish from Gurugram. What happens if car insurance renewal is missed by a few days and wants to know if zero depreciation cover is worth the additional premium?
Absolutely. So if you have missed your car insurance renewal,
Hello?
you just need to contact your insurance company. The insurance company is not going to renew your policy just like that. They will typically want to do an inspection of your car. So they will send a surveyor to your house who will inspect your car. All the damages that are there on the vehicle at that date when they are basically going to give you a renewal of your insurance, those will be recorded and those will not be covered in your insurance policy. You probably will have to pay it from your own pocket. All new damages is what will get covered from the day the inspection happens, and those get recorded onto the policy. The second question is about zero depreciation. Zero depreciation, in my view, for people who want to keep their car maintained, who want to ensure that they have lowest amount of out-of-pocket expenses, is a great boon. Typically, I would always recommend that people have that. Unless you are not driving your car at all, you are basically someone who's just having a weekend car, or you probably don't drive your car even 5 times a year. In those situations, zero dep may not be useful. But otherwise, if you're driving your car regularly, then it does make sense to have zero depreciation, because it ensures that you don't have to pay anything from your pocket. Typically, the outgo that you will have is in the zone of around 2,000 rupees if you have zero dep, and everything else will be paid by the insurance company.
Last question for the show. This is from Raj. He's from Jalandhar and wants to know how long life insurance claims usually take to settle. Also wants clarity on why some claims take longer than the others.
Right. So insurance claims typically, in the ideal scenario, should not take more than 7 days to 30 days, life insurance claims to get paid. Only when there are complications is where issues arise. Complications could be, first complication that's the most common and which is something that we keep hearing on social media, is about early claims, where someone has just bought a policy in the first couple of years. If there is a claim that has come, then in that scenario, the insurance company may go ahead and do an investigation. If the insurance company does an investigation, then the claim could take more time. It could take time from 45 days to 90 days from the date of the person passing away. That could be the kind of time that it could take. It could take even more time if the papers are not available with the nominee, whatever papers, whatever proof that the insurance company is trying to find out before they make the claim. The other situations are where there are things related to things which are criminal that have happened in that specific death, right? So those kind of situations also, insurance companies will have to do more diligence, more than the diligence that they will have to do for a natural death. So those kind of situations take more time. Apart from that, usually, ideally, it should not take more than 7 to 30 days.
All right. I think with that, we are timed out on the show as well. But thank you so much, Mahavir, for joining us and answering our viewers' queries today. Thank you. And for our viewers, it's time to sign off. But I'm going to leave you with our WhatsApp number and email ID. Keep sending us your questions. Thank you so much for watching. Goodbye.